Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man speaking everything chameleon, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to go through the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. And with that, I'm going to share my screen. You guys saw the disclaimer. And while I'm doing that, if you're joining us for the first time, welcome. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on the show and ask your question live, we do provide a link to Zoom on that live chat. Click on it. Once you log into Zoom, press on raise your hand. That tells us that you have a question. Once we let you in, you could ask your question live. While we're waiting, to give you guys a chance to put your questions in and to give a chance for more people to join us, we'll take a couple minutes, look at the pre-market report, see if we could get insights on what's going on in the pre-market hours, and then we'll move on to the questions. So pre-market report, these are stocks trading in the pre-market hours. I'm going to come down here and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. We got 25 stocks that made our percentage gainers list, 25 on our decliners list. So far, looks like a mixed bag in the pre-market. We're trying to see if we could get some insights if there's an overwhelming amount of stocks that are trading higher or lower to kind of assess the pre-market sentiment. So from this perspective, kind of a mixed bag. Let's look at it from another angle. I'm going to come up here and we have a calendar view going back days. Today is October 5th, so we'll stay on this date. And we see that there are 281 stocks trading higher in the pre-market hours, 309 stocks trading lower. As far as volume of shares, we got 102 million, almost 103 million shares trading higher in the pre-market versus 48 million shares trading lower. And if we convert the volume, of shares to dollar value, because not every share is the same price, we got $700 million worth of stock trading higher versus $1.9 billion worth of stock trading lower. So this is indicating a slightly more bearish bias at the open. All right, more stocks are down. The dollar value of the stocks that are down is way exceeds the dollar value of the stocks trading on up volume. Let's take another look at it from one more perspective, then we'll move on to the questions. I'm going to come down here, and when we look at this list of stocks, we see there are small cap stocks in their ETFs, leverage products, any security really that's listed on a major U.S. exchange. If it's trading in pre-market hours and it meets our thresholds and conditions that we set for liquidity, volume, price, and stuff, we can make this list. To narrow this list down to a smaller group of stocks, we could use the filters above here. And if you have a watch list, you can do it by your watch list. I'm going to use this one in ETF, which is a filter that if you click on it, you get different ETFs to select from, sector ETFs. These are the broad-based ETFs. And when you click on one of them, let's click on SPY, the table below gets filtered by stocks that are holdings in that ETF. So SPY, S&P 500 constituents, and here we got 2 stocks that made our percentage gainers list, 9 on the decliners. So from this perspective, looks like slightly bearish bias in a pre-market trading. So let's see, we gave it a couple minutes. Will, if you have questions, we'll take the questions now. You're on mute, Will.
Yeah, sorry, Dio. I was having a coughing attack. Apologize about that.
No,
I'm looking back. No questions have popped up yet.
okay. Let's go to, let me see. What do we stop?
Actually, we did have a question that was put out to the crowd. I don't know if you have input on it. Mike was asking, when does the price of a stock go down in relation to the dividend payout? Is it after the declaration date or after the X date?
Yeah, that's a good question. So, let's go.
That question actually came from one of your favorite spots in Florida, Naples.
Oh yeah. Now, I'm starting to think about Naples as we're getting closer to the winter season.
As the leaves are falling and it's a little chilly at night.
Yeah, we have friends live in Naples, so we visit them. Usually, I think it's in March, which is very cold up here in the Northeast, February, March. So, and down there it's beautiful. So, we were just talking about Naples actually this morning. But getting to the question with the ex-dividend, when a company pays a dividend, right, there's an X date, then there's a pay date. So the X date itself, you could see over here, these are the X dates right now. So today's X date, October 5th. So these are trading X today. These will be trading October 6th. These will be trading X date tomorrow. So you need to own the stock prior to the X date. Right? You have to buy the stock prior to the X date in order to receive that dividend. Right.
So if the X date's today, it would have been yesterday. You would have to buy this stock.
You don't have to buy
or own the stock.
Right. So the X date means this is the date that it's trading X dividend. No dividend, right? Minus the dividend. And you'll see the stock price adjust by that amount. Usually that's the adjustment. So you do need to own the stock prior to the X date, and that's important because if you have say an option, right, that's deep in the money call, we'll see in JP Morgan, right?
Oh, you can bet those dividend players were playing it.
Right. So what would happen is that we probably see a lot of deep in the money trades where there was open interest and that open interest went away. So you see here, these are deep in the money calls. And what happens is if you have a deep in the money call, say on a 125 strike, well, that call already behaves like the stock. Right? It has 2 days to go to expiration. So this call basically goes up and down dollar for dollar with the stock price. So it behaves like the stock. So you don't have any really leverage in it anymore, right? It's not like an out of the money call where you still have time premium and leverage. There's no time premium in it. And there's no real, leverage is going to behave like the stock, right? But if a stock goes ex-dividend, right? If it goes ex-dividend, the shareholder who owns the stock is entitled to the dividend because you're a shareholder in the company, right? So if you own the shares, you're entitled to that dividend. Options, right? These are just contracts between people. The options are not issued by companies. These are created completely by third parties, right? The company has nothing to do with these options. So now you have these contracts and the options don't have a dividend. You're not entitled to a dividend because it's just a contract between one person and that, you could buy this stock at this price, some before this expiration. That's the contract. So since you're not entitled to the dividend, you have to look at it and say, well, if I'm not entitled to the dividend, I may want to convert my option to the stock so I do get the dividend, right? Because at that point, okay, what, I'm going to own this stock in 2 days, right? I have 2 days to go. So this will get converted to stock anyway, right? It'll get, if the stock is here, right? This will get converted to stock in 2 days. But if I do it, exercise it now and do it earlier, well, I get the stock now, but I also get the dollar dividend, right? I'll get this. What was it was like $1, right? $1.05. And that's why when it becomes an early exercise candidate. So let's go back yesterday. So let's look at the open interest yesterday. So you see all this open interest, see all these deep in the monies, right? You got open interest 20 lot, 5 lot, right? 11, 39, right? You got all this open interest, even down here. This is an early exercise, because you could see these are all bid below, right? Look, all the way up to, probably even, I would say up to this 138, definitely looks to me like. So you see these, and probably out here as well, all these deep in the monies. These are all early exercise candidates, right? Maybe not this one. This one, the put is bid pretty high, but let's go back to October 6th. So on what happened? Look at all these open interest, right? If they're paying attention to the dividend, and you have a good risk management system, then you're going to look at it and say, these are early exercise. Why would I give up $1 dividend? Like, why would I do that? You need to justify it. If you can, then you should exercise and get that dividend. So let's see, up to, what did I say? Let's say up to 138. Right, all these become, so somebody probably forgot. There's always somebody who forgets. So let's just see what happened. Yes, the new open interest. So hold on, let me change this to open interest. So here is, what did I say, up to 138. So okay, so the 138 guy ended up not exercising. There's 200. You could see a lot of them got exercised, a few people forgot, right? So there's always inefficiencies, right? These guys are efficient. This guy forgot, that's probably a mistake, right? The 138, because he could have exercised it, got the stock, received his dollar dividend, and if he wanted to protect themselves on the 138 line, could have just bought this put for 13 cents. So it's important, to understand that, how the ex dividends work, the dynamics of how the options work, to be able to capitalize on it. Because when we trade options, when we price options, when we trade options, it's always assumed that you're doing the most logical and efficient way of trading, right? You're looking at the options, and the actions that you're taking are the most logical and the most efficient. Because if you're not doing that, there's really no strategy, right? There's no strategy for somebody who's not logical or inefficient. They'll just lose money, right? There's no way to convert that to a winning strategy, right? It's hard enough to create a winning strategy, but all those strategies always have the assumption you're doing the most logical, rational, and efficient thing. So this, to me, was inefficient. This, if I was the risk manager at this bank or whatever, and I've been like, well, what are you doing here? Like that, that doesn't, you explain to me why you did this, right? Like I would have to go in there and really know why that person left those 200 on the book. There should be a good explanation, because that doesn't seem like something rational and logical to do, because you have 2 days to go. You could have exercised this, right? What happens is you exercise it, you convert it to stock, right? So once you convert it to stock, you get that dollar dividend. Well, what do you lose out? You lose out on the limited risk of the call, right? So what happens is you're below 138, you're no longer protected because you're long the stock, right? So what do? You buy the put on the 138 for 13 cents, and there's your protection, right? If the stock falls below 138, yes, you lose on the stock, but your put will kick in and give you that same protection. But you paid 13 cents for the put and you got $1.05 for the stock. Doesn't that make sense to do it, right? To swap out getting $1.05 to pay 13 cents. So it's a good question to know the ex-dividend, how it works, and the dynamics of the options, so you could trade the most efficient way.
Is there a spot where you can look at how the stock has performed previous ex-dividend days relative to its dividend?
Yeah. So let me see. I think it's under events here. Right. So under events, we could pull up different types of events and how the stock performs. So I'm going to do X date here. So here we could just kind of see the history of like what the stock did 1 day before X. So you can see here it tended to go up. All right. This is how it behaved after the X date. So like 50-50 up or down the next date, the next day. This is the drip, and this is how it did afterwards. So you could see that at least for JP Morgan, it tended to run up the day before. Of course, the market also went up yesterday, so this is in sympathy with it. But at least in history, it shows that day before the X date tends to rise more often than not.
And what about the day after the ex-dividend? Does that show too, or is that not available?
So that's over here. So this would be the 1 day after, right? So it would measure from, if we did it, the reference prices would be from today's close to tomorrow's close, right? That's the data. So from today's close to tomorrow's close, these would be the historical performance metrics. So you could see that there's looks like a buildup the day before, and then the day after looks like it tended to sell off more often than not. So those are the historical data points of JP Morgan, which actually one of the interesting things, as we're sitting here, when we look at these data points, one of the strategies that people employ, quantitative is, and somebody emailed, maybe they're watching it, Markov chains. So Markov chains looks at the current state of a stock, the current state of a situation, and then measures the transition to the next stage, right? Like, for example, stock going, if whatever the current state is, right, is it more likely to go up or down? What's the next transition? And this was, I think, that's what Renaissance, what's that hedge fund? Renaissance
Capital, yeah.
Yeah, Renaissance Capital. That's one of the methods that they employ, is that the Markov chains, where they they look at the current state and say, well, what is the probability, of it transitioning to a higher, or where's it more likely to go the next stage, higher or lower, and then they would create those Markov chain processes to find a statistical edge, and they would start employing those types of strategies across the board. Of course, you'd have to do more analysis, but this would be a starting point or theory of how something may have transitioned, right? Like the day before an X date, for example, that's a state, right? That's the current state we're in. The day before, how does the stock tend to transition from up, to the next stage, up or down? So somebody emailed me, Markov chain. Actually, since that email, I've been reading a lot about it. Basically, trying to see how to set up those Markov chains, run those tests. Get there's lots of stuff involved there. Then you got to see if it's statistically significant, and you're looking for anomalies in the market. But just throwing out the idea there is, you try to look at certain states, that you think could be meaningful, right? And then you test it out to see how does the stock tend to transition. So
we did have a couple questions about the dividend payout previously in TSLY, something I guess quite a few of the chameleons participate in this product.
Okay.
I don't know if you can take a quick look at how it's responded. It pays monthly. We wanted to see how it shows.
So this must be like a new.
Well, it is a newer.
Yeah. So
I don't know how
as much.
product is.
Yeah, as much data, but there it is here. And look, when you look at this, there are other factors you might want to look what else happened throughout those days. But what I factor in what the market did, if I factor in any other news or something. So you got to go when you're setting these up. A lot of what you're doing with models when you're building models is setting up the data. Setting up the data is like 99%, because if you don't have the data set up correctly, the models, they're just going to give you output, right? So what do they call it? Garbage in, garbage out, right? So you setting up the data, the information, and understanding it is 99%, because you could have really, you could be a great statistician, you could be a great you could understand math better than everybody else, but if you don't have good data that you're feeding it, or that you don't understand the dynamics of the data, then it's going to be garbage in, garbage out. So that's an important thing to understand. But yes, setting it up, looking what other things that could be contributing to here. How do I get the cleanest, most precise data?
Brett is just asking for clarification relative to the X date. Does settlement date have an effect on when you need to own the stock to receive the dividend?
Yeah, well, that's why you have an X date.
Yeah.
X date assumes you're going to settle it before the record date.
Before
right?
the X date.
Right.
Your
So
settlement, it'll be settled the day before that you own the stock.
Right, because what happens is you have to own it by the record date, right? The day of record, right? So your ownership has to be recorded. So to own it on the record date, you have to actually trade it before the X date, right? Because it settles later. So the X date's telling you when you have to actually purchase the shares in order to give it time to settle before the record date. So yes, the settlement date is important, but the ex date's telling you if you're going to buy it, right? It's kind of an indicator when, if you're going to buy it, you got to buy before that, because you're not going to settle by record date. So the ex date is really like that. Once the ex date passes, you could buy the shares. You're not going to get the dividend. That's what it's saying. You could buy JP Morgan today, but you're not getting the dividend. It's already X, right? October 5th, it's X date. You're not going to get the dividend if you buy it.
Good. We did have a question for Jackie, but we're right up against the opening. Maybe I'll send it to you for tomorrow. He was asking how to use MC Screener tool to search calendar option spreads with edge and win rate. Is that even available?
So the one way right now to do it is that we don't have a screener like this, just to like screen out like these, because first of all, we have already a lot of these screeners working in the background. So what we did was, for the calendar spread, it's very intensive calculations. So what we did was filter out calendar spreads and put them in alerts. So if you set these alerts to just say, here, bullish calendar spread, right? Bullish calendar spread. So today there are no alerts because the markets aren't open yet. So this is scanning them throughout the day. And when something that fits that criteria, like you just mentioned, there's a calendar spread with a theoretical edge, it'll pop up in here, so you could click on it and start looking at. If you have a symbol, you could also just type in the symbol in here, like say I want Apple, type it in here, and you'll be able to do it that way. But you're scanning them throughout the day, because there's so many strategies out there that creating a screener for every type of strategy, what happens is it takes up a lot of processing, right? One screener like this takes up a lot of processing time, starts slowing things. It slows things down. So what we decided to do was, and most people just wanted like a trade card, almost, filtered out like this. So maybe we'll create a trade card, like a trade idea card like this, which uses, the preset filters, and it'll be like your starting point. But right now, the way to do it is from the alerts. You could filter by calendar spreads.
All right. Awesome job, D. Thanks to the Chameleon community for the questions. We are just about at the opening, seconds away. Awesome job, buddy.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, Chameleons. Have a great day, D.